Last year, many investors suffered losses of 20% or more. Many have been told that this is the price that must be paid in order to achieve acceptable long-term returns. This does not have to be the case. Alternatives to buy and hold investing are available to guard against large declines in the value of your investment accounts. The losing trend of 2022 may not be over, especially if either of the last two major market corrections are examples of what is possible. A variety of asset classes have declined together. Avoiding losses through diversification could be a difficult task. In 2023, resolve to limit further depletion of your investment accounts by participating in a tactical approach that has produced excellent long-term returns while limiting losses. Over the last 31 years, the managed risk tactical approach delivered better returns than a 60-40 stock and bond portfolio. It's the green line on the chart behind me. With only 8% maximum drawdown, compared to a 33% low for the 60-40 portfolio, which is shown in red, it has been more return for less risk, and certainly less stress. Because 31 years is a long time, it's also wise to consider past performance on a 5-year rolling basis. Looking at the top panel, you can see that the average rolling period returns for a 60-40 portfolio were respectable. But there was a 5-year period when the annualized return was negative. Looking at the bottom panel, not only was the average return of the managed risk approach slightly better, but the worst 5-year period was positive and 3 times better than the 60-40 portfolio. Consider the contrast between a static buy and hold approach and an active tactical approach during times of market stress. During the bursting of the tech bubble, a 60-40 stock bond allocation was in drawdown and recovery for over 4 years, and you would have been down 23% at some point. During this same period, the managed risk approach delivered 42% and kept drawdown to less than 2%. During the financial crisis, that 60-40 portfolio took over 3 years to decline and recover. Many lacked the fortitude to hold on during a 33% drawdown. At the same time, the managed risk approach delivered 74% and kept drawdown under 5%. The long everything rally supported by ultra-low interest rates, lower taxes, and globalized trade came to an end as we entered 2022. The investment environment has changed, and you might consider changing with it. How did your current investment approach or asset allocation do during past major market corrections? How did it do last year? What are its prospects going forward? Don't spend years recovering from investment losses. Manage risk first. Adopt a viable approach for all market conditions. If you are approaching or in retirement, if you're expecting to have to use your investment assets to make a major purchase in the not-too-distant future, or if you just want to sleep better at night, a conservative risk-managed investment process may be for you. Contact Mike at trendhaven.net to learn more about a safe, liquid investment approach with a track record of success. That's his email address above. Performance of the managed risk approach and the S&P and aggregate bond index portfolio are total return based upon month-end results. The managed risk performance is shown net of a 1.5% annual advisory fee taken quarterly in advance. The S&P and aggregate bond index portfolio is shown net of a 0.5% annual advisory fee, also taken quarterly in advance. Verified actual returns shown are the performance of both Trendhaven and the provider of the same quantitatively driven analysis used by Trendhaven. All investment involves the risk of loss. Past performance is not a guarantee of future returns. Thanks for watching. Wishing you the best in 2023.